Hello, you can hear me now?
Yes, we can hear you. Good morning.
Good
Yes,
morning. How
we
are
can
you?
hear you now.
Okay, yeah. Good morning, everybody.
Good morning.
How are you?
We are very much fine. And you?
Okay, thank you very much.
Yes.
Okay, we are about to start our webinar. We are just waiting few people to come, then we will actually start. So give us some few minutes, maybe two, then we will start our webinar. Thank you very much.
Sawa sawa.
Gifty, how are you?
Yes, good morning, Mr. Nja.
Good morning. So maybe you mute the other people so we can talk.
Okay.
Nani ameingia?
Let me call you on the phone.
Okay.
I'm fine. I'll stop by your
Um, hello, good morning, everybody.
Good morning.
Okay, good morning. Okay, welcome to EABC webinar for the pre-budget 2026-27 financial years. My name is Adrian Zhao, Trade and Policy Advisor with the EABC. My role today will be to moderate this webinar. We take this opportunity to thank you and welcome you for this important webinar. And also we thank the PwC for collaborating with the EABC in actually organizing this particular webinar. But also we appreciate the collaboration with EAC Secretariat for also actually joining us in this webinar and be one of our facilitator in terms of actually highlighting some progress and development as well as challenges in terms of implementation of the common external tariff as well as harmonization of domestic taxes, especially excise duty. Today, our program will start with welcome remarks from EABC Executive Director, Mr. Ahmed Farah. Then we will have an open remarks from our Vice Chair and the Chair of the Policy and the Advocacy Committee, Mr. Simon Kaher. And finally, we'll have official opening from Madam Annette Semuemba, Deputy Secretary General in charge of Customs, Trade and Monetary Affairs in EAC Secretariat. After that, we'll go to the presentation from the EAC Secretariat, where we'll get the insight of the status and challenge of implementing the EAC Common External Tariff, as well as the progress on the harmonization of excise duty. From there, I think we'll go to national budget presentation focusing on on proposed tax measures for the 4 EAC partner states, which are Tanzania, Kenya, Uganda, and Rwanda. I think most of you may be asking why only these 4 countries, because the 4 countries have already aligned their fiscal year, which started 1st July 1st July each year. Burundi is actually waiting to align, but the other country like DRC, Republic of South Sudan, and the Federal Republic of Somalia have not actually starting to fully implementing the EAC commitment, especially the common external tariff and the other fiscal measures. Then we will have a question and answer, and I think we'll close our webinar. Now let me go through the rules of our webinar. We request to mute your microphone and the video if you are not speaking. And when it's come to contributing, make sure that your focus is on what actually have been presented with focus on the tax measures for this particular fiscal year. Also, when it's come to question, can be sent it to our chat room, and we'll try to respond them. Meeting will be recorded for reporting purpose, and the report of the meeting we are going to be shared after prepare the report. Maybe my colleague Gabriel can tell us if our ED is already, then we can welcome him for the remarks.
Thank you, Adrian. I am in the room.
Oh, thank you very much.
Yeah.
So please welcome and you make a welcome remark. Karibu sana.
Asante sana, Adrian. While I'm starting my remarks, I just want you or Adrian or Patrick to try and help Annette. Our chief guest is trying to connect as well. She's struggling.
Okay, let Gifty handle that. Gifty, can you assist in the Annette join? Maybe we wait a little bit for the our chief guest to join.
Thank you. I think that's a good idea. Thank you, Adrian. Let's just give a minute.
Thank you, Adrian. Let's just give a minute.
For her.
Maybe while we are waiting for our chief guest to join, maybe we can a little bit explaining the objective of our webinar, which actually is trying to creating the dialogue, public-private dialogue, with the intention actually of having the competitive and harmonized EAC markets. But from this webinar, we will hear the proposal from the 4 EAC partner state, but also we look those proposal tax measures, which we think maybe they are not in line with EAC commitment, EAC aspirations. For those tax measures which we think they are going to frustrate intra-EAC trade and the investment, we will submit our proposal to EAC partner state, especially the relevant partner state, which maybe is coming with that tax measures, in order to do the reform, which actually will align them with EAC commitment in terms of the protocols and also the treat. Because most of the time we have seen some of the tax measures which is against the EAC commitment, especially those tax measures which maybe we think they are discriminatory against the EAC goods or the EAC services in the region. So that can be one of our objective of this particular webinar. But also in concurrently with this webinar, we are actually collecting private sector tax measure proposal, which also we are compiling them. And with this webinar, we'll try to look which EABC harmonized position is supposed to submit to EAC Secretariat as well as to EAC partner state. Maybe Chief can tell us the development in terms of connecting with our chief guest.
Yes, Mr. Njau. Actually, we requested for a few more minutes because we are having a problem with the Teams. It is having some kind of glitch because people are not getting the joining link. So, Mr. Adon, we requested for more, 5 minutes
We can now start, Adrian. We have our chief guests in the room.
Okay, thank you very much, and apologize for the technical hitches some of us we are facing in joining our webinar. Now let's take this opportunity to invite EABC Executive Director, Mr. Ahmed Farah, to make a welcome remarks. Welcome, Executive Director.
Thank you very much, Adrian. Our chief guest, Ms. Annette Mutawe, Semwemba, EAC Deputy Secretary General for Customs, Trade and Monetary Affairs. Mr. Simon Kaheru, EABC Vice Chair and Chairperson of the Policy and Advocacy Committee. Representatives from PwC, East Africa Business Council Board Directors present, East Africa Business Council Goodwill Ambassadors, East Africa Community officials, East Africa Business Council members, distinguished CEOs and directors, media fraternity. Ladies and gentlemen, good morning and a warm welcome to the 2026-2027 East Africa Business Council pre-budget webinar on harmonizing tax proposals for a competitive and integrated EAC market. It is my privilege on behalf of the EABC to welcome you to this important webinar convened in partnership with the EAC Secretariat and PwC. This webinar provides a timely platform to reflect on our shared vision for a harmonized fiscal environment that supports regional trade, investments, and economic prosperity across EAC. Ladies and gentlemen, the continued joint reading of budgets by 4 East Africa partner states, namely Kenya, Uganda, Rwanda, and Tanzania, each June, underscores the region's efforts to harmonize fiscal measures. But however, as highlighted in our analysis of the 2025-2026 national budgets during the post-budget webinar held in August 2025, the region continues to face 2 main challenges in its fiscal measures. The first one is the wide divergence in the application of the EAC Common External Tariff, version 2022, coupled with numerous requests for stays of application and country-specific duty remissions. Secondly, there are disparities in the application and enforcement of domestic taxes, including excise duty, VAT, and income tax. So although the EAC Common External Tariff underwent a comprehensive review in May of 2022 to boost regional industrialization, value addition, and competitiveness, partner states continue to submit requests for stays of application that suspend implementation of revised tariff lines. This trend suggests that national interests still often take precedence over agreed regional commitments, thereby weakening the uniform application and effectiveness of the EAC Common External Tariff version 2022. Our analysis of the financial year 2024 national budgets shows that there were 1,956 tariff lines under stays of application, which account for 22% of the EAC CET. In financial year 2025-2026, this rose to over 2,464 tariff lines adjusted through stays of application or duty remission, accounting for 41.3% of total EAC tariff lines. This upward trend in stays of application and country-specific duty remission is weakening the common character of the EAC Common External Tariff and reducing its effectiveness as a guiding framework for taxes on imported goods into EAC market. The disparity in the domestic tax regimes is also driven by the slow pace of harmonization of domestic taxes. This continues to hinder the free movement of goods, capital, and services, as well as the optimal allocation of resources. Discriminatory taxes levied on East Africa community originating products compared with similar domestic products remain one of the key factors behind unresolved non-tariff barriers. From the private sector perspective, the expectation for the financial year 2026-2027 national budget is clear. Partner states should review their finance acts to eliminate all tax-related NTDs. They should also refrain from introducing tax measures that contradict the aspirations of the EAC Regional Integration Framework. Ladies and gentlemen, The main objective of this pre-budget webinar is to promote dialogue between the public and the private sectors in shaping tax policies, with the aim of harmonizing tax measures and eliminating discriminatory taxes, levies, and charges of equivalent effect. To advance this objective, today's webinar is structured in 3 parts. The first one is the EAC Secretariat will share insights on the status of challenges and implementation of the EAC CET version 2022. This is one of the key instruments under the East Africa Community Customs Union. The Secretariat will also present progress on the harmonization of excise duties and the challenges that continue to delay conclusion of this process. Secondly, PwC will present the proposed tax measures in the financial year 26-27 national budgets with a focus on the 4 countries, Kenya, Uganda, Tanzania, Rwanda, and Burundi. Sorry, 5 countries. The presentation will cover the EAC, CET, and domestic taxes, including excise duty, VAT, and income tax, and highlight the likely implications for regional business. Thirdly, we will come in as the conveners of this webinar to identify critical tax measures that are not aligned with EAC commitments and submit them to the EAC Secretariat and the respective partner states for consideration. This will be complemented by the ongoing collection of proposals from businesses across the region. Ladies and gentlemen, I encourage all participants to engage actively, share their insights, and put forward recommendations that will support a more coherent, predictable, and business-friendly tax framework across the EAC. Thank you for joining us, and I look forward to a productive session. Over to you, Adrian.
Okay, thank you very much, executive directors. I think you have heard from our executive directors, and because with the interest of time, I think we are going to invite our vice chair and the chair of the policy and the advocacy committee, Mr. Simon Kaheru, to make his remark. Karibu, director.
Thank you very much, Mr. Njau, Adrian, and Executive Director for kicking us off. And I'll try and keep this short since we've started late and we need to focus on the meat of today's discussion.
Yes, yes.
Yeah, thank you for that reminder. Gift, could you kindly assist Director Simon to get back to the room? I think he must have dropped off.
Not a AD.
Adrian.
Edie,
Yes, Executive Director, maybe we can.
Okay. We have our director back in the room. Maybe we can do without video, Director Simon.
yes, sorry, but we have very strong rains. There's a storm right now.
Okay.
So there was a clap of lightning that preceded my dropping off. Kindly advise where I dropped off from.
Maybe we could just start again. We are just introducing yourself.
Okay, apologies, people. So again, so I've finished the protocols, and I'll jump straight to thanking the EAC Secretariat, Madam Annette. Please convey our thanks to all the staff and PwC for bringing the right level of professionalism to these discussions every single year and elevating the quality of analysis that we use both at the public, as a public sector and private sector. Ladies and gentlemen, this process of building and presenting these national budgets across East Africa should be commended. It's been seamless, transparent, and has been carried out with relative consistency over the last so many years. So we applaud the governments for working hard to keep it harmonious in terms of timing, especially. But as Edie stated, there is still work to be done harmonizing the policies that inform these budgets, and we are hopeful that this work will be conducted and create the fruits that we want. But as we speak today, I'm happy to note that the private sector has been given very good opportunities to weigh in on all these fiscal policies across in the individual partner states, and through dialogues of this nature across the entire patch. In recent years, this has become even more important because of the geopolitical shifts that we are seeing arising out of various types of conflict, including the recent war that has broken out in the Middle East. And as we all know, our individual East African governments are not involved directly in the wars, but we, the private sector, and even the people of East Africa experience the effects almost firsthand. And today, in many of our countries, we are talking about the effect when it comes to the fuel pumps and its impact on basic logistics, but also manufacturing. And that's why, as a private sector, we must raise our voices in these conversations around the management of our economies, in line with the charge that EAC integration needs to be people-based and private sector-led. And this is the reason why today the EAC private sector, justifiably, I should say, expects that the new tax measures in the budgets that we're going to hear in a couple of months will take our recommendations into account, because our recommendations are all designed to improve the business environment, regardless of what happens outside of East Africa. The unfolding negative impacts in those geopolitical tensions should not stop us from doing business or growing our business. And among the recommendations that we've put forward in some of the individual partner states that we've seen, and those that we must advance even further, is increasing our integration, increasing our trade amongst ourselves, so that we are less reliant on external markets and external factors, especially for supplies, even though we do need to be reliant on them as an expanded market for what we produce. So, ladies and gentlemen, the new tax measures in our discussion today, we need to ensure the new tax measures should not make our business environment worse, but more conducive for intra-EAC trade and investment. Today, the pre-budget webinar we're going into will focus on the tax proposals related to the common external tariff, as ED highlighted, as well as various domestic taxes, excise duty, income tax, and VAT, to try and get rid of the disparities and also take out the negatives and loopholes that make it difficult for us to trade across this region. The slow pace of harmonization of taxes has given partner states, the opportunity to go the wrong direction as far as Jumuiya is concerned. But whenever we gather in platforms such as these, have the opportunity to fix that. So please today, excuse me, let's make sure we use that opportunity with the experts we have in the room. We need to get rid of domestic taxes that are discriminatory against transferred products, those that get in the way of increasing EAC trade, and those that do not look at SMEs as well as a very integral part of the engine of growth that is business in East Africa. So as I call upon you to start the webinar and conduct it with full focus and success, I would like to urge our partner states to fast-track harmonization of domestic taxes, eliminate discriminatory fiscal practices, so that together, private sector and private sector, we create a level playing field for all our players in the EAC and facilitate optimal allocation of resources to do more business across the partner states. This will make us more competitive across the continent as we take advantage of the Africa Continental Free Trade Area. So with that, ladies and gentlemen, I trust that through today's discussions, the EAC private sector will have the opportunity to critically evaluate how all these measures that have been proposed will impact our business, but even more importantly, grow our business and the regional economy in general for all East Africans and Africans. Asante sana, ladies and gentlemen. I wish you fruitful deliberations and a successful financial year ahead. Thank you.
Thank you very much, our Vice Chair and the Chair of the Policy and Advocacy Committee. You are for a very insightful remarks, and your remarks is dry and clear. So without much ado, I think let's invite our Executive Director to invite the Deputy Secretary General of EAC to make remark. Mr.
Thank you very much, Adrian. It's my singular honor to invite our chief guest, Deputy Secretary General Annette. Over to you, Annette.
Thank you very much. Thank you very much. Executive Director, Vice Chairperson of EABC, the Executive Director and your team, distinguished representatives from the EABC, PwC, policymakers, captains of industry, and all participants that are joining us virtually. A very good morning to you. Habari za asubuhi. It's a pleasure to join you at this. It's a pleasure to join you at this pre-budget webinar convened under the theme Harmonizing Tax Proposals for Competitive and the EAC for continuing to provide this platform where together as policymakers, as coordinators of the integration agenda, and as business, we meet to share perspectives and also discuss practical solutions that are very important for our region. As I reflected on this discussion, I also reflected on the timing. And while I agree and appreciate that we've been having continuous engagements, perhaps we may need to rethink the timing to ensure that our proposals start to feed into the discussions way on in the process, because as it is now, by around this time, some of the partner states through their parliaments have already started to consider approval of the budget. So that's just a point for consideration. And as we prepare our timetable for these engagements. But I see we proposals. That notwithstanding, perhaps it is also worth considering that we convene these discussions from the lowest levels upwards till budget approval, so that we do not miss the boat. As partner states finalize their budgets for 2026-27, the global environment and geopolitical issues continue to evolve, and these factors continue to place pressure on fiscal systems. Debt continues to rise, and the expectation simultaneously is that businesses must remain competitive, resilient, and attractive to investment. And I think some of these points have also been mentioned by both the Vice Chair and the Executive Director. In this context, tax policy harmonization must be understood not as a technical alignment exercise, but as a strategic tool for building a competitive and truly integrated regional market. This is essentially the purpose of this discussion, to bring together two essential perspectives: the private sector, which experiences the direct impact of tax policy on, and the policymakers and coordinators who must design systems that balance revenue needs with growth and integration objectives. Objectives are not competing, but aligned. In various engagements, the issues of non-harmonization of domestic taxes remains a thorn, and the Executive Director has also mentioned this. Across the EAC, differences in VAT treatment, excise duties, and withholding taxes continue to shape business decisions in ways that in the various engagements, differences translate into uneven cost structures, cash flow challenges, and in particular, due to delayed VAT refunds, for instance, and increased complexity in cross-border operations. In fact, this also contributes to tariff barriers. While we recognize that these instruments remain essential for revenue mobilization and response, and we urge the private sector, because this process has commenced. Yes, we continue to request for the to be fast-tracked. We stand ready to support in the necessary processes that are needed. The harmonization process is aimed at ensuring that domestic tax systems change and be disruptive across the region. I hope that you're all aware of the respective studies around VAT and excise principles, as well as indicative bans in key sectors, so as to reduce harmful divergence while preserving limited flexibility. Allow me to also touch on the subject of the common external tariff. The common external tariff remains a cornerstone of the customs union and a key instrument for shaping regional competitiveness. And as we have heard from the ED, the increasing use of stays of application, while providing necessary flexibility, have also been observed to introduce uncertainty. From an investor perspective, predictable tariff policy is essential for sourcing decisions, pricing strategies, and long-term investment planning. However, it must be noted that flexibility is often required to address domestic priorities and support emerging industries. Indeed, the states of application that are applied are usually presented by the private sector to their respective partner states for onward submission to the EAC for engagement and subsequent approval. So we call upon the private sector, as you reflect on these stages of application, think about the broader picture, think about the broader regional integration agenda, and and the implication of those stays with respect to predictability of the EAC tariff policy regime. Within containerization, our to strike a balance between flexibility and predictability in a manner that's intimate. In regard, we continue. It also requires that decisions on the common external tariff are aligned with regional industrialization and competitiveness goals, rather than driven solely by short-term national consideration. And it is for this region that, as the EAC, we continually undertake analysis and coordination to ensure necessary adjustments should this be required. And in the coming years, we will be undertaking the next exercise in line with the Customs Union Protocol for review of the common external tariff, and perhaps some of these issues could be absorbed in that process. These studies, this analysis, is support evidence-based processes and to ensure that the changes are clearly understood and can be anticipated. So it is our expectation that together with EABC, we will continue to engage on the necessary data on supply chains and input requirements, helping to inform more responsive and coherent tariff decisions. The next issue that I would like to speak about is the issue of non-tariff barriers. This too remains a thorn in our integration agenda. And while we have seen shorter processes for their elimination, we have also observed more reporting due to the various tools for reporting that we've in place. However, these two remain a challenge for the community. The process for their review is in place and decisions have been taken up to summit level, calling for elimination of all NTBs by June 2026. It is our expectation that partner states will respect these decisions of the summit, and in the coming meetings for the pre-budget, all the way to the Sectoral Council on Trade, Industry, Finance and Investment, that we will receive updates with respect to the elimination processes. We also note that there is need to strengthen accountability mechanisms for resolving NTBs and to fully operationalize regional frameworks such as the online reporting mechanism, the single customs territory, and also implement tools such as the EAC customs bond. All of these are meant to address issues of NTBs. We also expect that the private sector will continue to actively report barriers and engage constructively in the EAC will remain on this issue and will continue to do the necessary coordination. We have undertaken time release studies across our respective corridors where we have identified key choking points and are working towards addressing these issues with the aim of reducing the time and cost of doing business. I must emphasize, ladies and gentlemen, that as the region transitions towards a more digital services-driven economy, new areas of taxation, and in particular digital services and e-commerce, are becoming increasingly important. This needs to start to feature prominently in our discussions. For those who followed the discussions at the 14th Ministerial Conference of the World Trade Organization, you will observe that this indeed was one of the sticky issues. Harmonization in this area presents an opportunity to co-create a consistent and forward-looking regional framework. We need to work towards developing regional principles for digital taxation that are aligned with global best practice, while also reflecting on the realities of our economies. We know well how much trade is ongoing through various digital channels and how business models are evolving to incorporate digitalization. The youth, who are the biggest population in our region, more specifically, are at the center of many of these innovations. It is therefore important that tax frameworks are designed in a way that supports this innovation and growth while still safeguarding revenue objectives. As I conclude, I would like to reiterate that such structured consultations within the budget process and ensuring that private sector perspectives are incorporated before decisions are finalized are critical. We have activated engagement with the private sector through the EAC EABC Technical Working Group as part of the regional public-private sector dialogue mechanisms. This and through other forums, I appeal for greater use of business data and feedback to continuously refine tax policy. It is our expectation that constructive, evidence-based inputs, engaging consistently both at national and regional levels, and support to compliance and transparency within the system will deliver long-term impact. With these remarks, I wish you successful deliberations and positive outcomes in contribution to the upcoming budget process. I thank you.
Thank you very much, Deputy Secretary General, Madam Annette, for very, very insightful and encouraging remarks, which I think we will take into consideration, especially the private sector, to ensure that the proposal actually they are submitting, they are in line with EAC treat and our aspiration. Now I think it is high time I invite Mr. Jonathan from EAC Secretariat to make the presentation. With the interest of time, we are requesting we move somehow with the speed in the order actually to optimize our time. Mr. Jonas, karibu sana.
Thank you so much, the moderator. I hope I'm audible now.
Yes, from me, I can hear you very well.
Yeah, I've not put on the video so that the sound quality is better. Thank you so much. Good morning, everybody. I'm going to take you through the status of implementation and the challenges. And my presentation is re-emphasizing what the Deputy Secretary again has just highlighted in her remarks. So I'm going to highlight the framework, but I hope this one most of you are aware of the CET structure and framework, the highlights of the measures which are being implemented in the current financial year, the key challenges, the status of harmonization of the excise duties, and then implications on the regional businesses and what probably this webinar or private sector can do to engage with the policymakers. I think this is a known information to most of the participants in this webinar that the common external tariff came into force in 2005. And at first it was a three-band tariff structure, but now in 2022, there was a review and we came up with a four-banded tariff structure, including also the review of the sensitive items. In the managing of the common external tariff, we undertake annual CET reviews, which result into gazettement of the decisions. And as the Deputy Secretary General has mentioned, for some sectors where we feel that probably there's need to get informed decisions, we undertake studies related to production, demand, and the comparative advantage of the different countries in those specific sectors. So that's what the Secretary does in order to support this process. Now, I just want to make highlights of the measures that are being implemented in the current financial year. Probably maybe they can guide in as we progress towards the next financial year, 2026-27. That in the act, I mean in the tariff lines, 2,464 tariff lines have been adjusted via stages of application and remissions, which is a really big percentage. It means that only probably 60% is what is being implemented without the request for adjustments, either upwards or downwards, to support the different purposes for which these requests are done. And it's a mixture, the adjustments are a mixture of high duties on sensitive finished goods, and then zero rates and the reduced rates on capital goods, and also hybrid rates. Some of them are using ad valorem, other specific values for purposes of computation of taxes, and targeted duty remission schemes for inputs, raw materials. So this is what is the prevailing in the current financial year. So as I mentioned, we are monitoring or supporting the process of managing the common external tariff. However, the challenges are still persisting, as we have mentioned, that we are still receiving frequent requests for stages of application of the CET. Countries are asking for specific tariff adjustments. So this is undermines the common nature of the common external tariff. And as I mentioned, that more than 40% of the tariff lines they are adjusted. So which means that in terms of enforcement, the adherence is on only 60%, probably, which is needs to be addressed. And this one arises from quite a number of priority requests. Some of them are based on revenue mobilization, industrial protection, and then trade liberalization. And again, as the implementation is going on, we are still facing challenges of non-tariff barriers, which actually impeding. Some of them much more restrictive than even the tariff barriers themselves, because we are getting denial of market access, which is resulting from export bans, import bans, administrative restrictions, and issues related to sorry, I think there was a network challenge on my side.
Continue, we
So-
can hear you.
Yes, yeah. And there's also another challenge which is also affecting the common external tariff. This one arises from the overlapping regional commitments, whereby partner states are members of different regional economic community, and where they have to adhere to the tariff commitments, for example, COMESA and the other regional bodies like SADC. So these are also impacting the implementation of the common external tariff. Now, when it comes to the harmonization of excise duties, what we can report here that harmonization is an ongoing exercise, but it's not yet complete. And there are a number of variations when it comes to excise duties on certain products. So which impacting the trade across the region, because if in one partner state there are higher excise duty on particular products, which then this one impacts the intra-regional trade. So, and the reason why some of these exercise structures vary. Partners still feel that probably this is the area where they still have a leeway to manage their domestic revenue sources by providing for different exercise duties or to restrict flow of goods. So now this one causes serious challenges, and that's why the process of harmonization has delayed. But probably it's work in progress, and we hope that this will be harmonized together with the other taxes which have been mentioned, like VAT and income tax. And so the Secretariat is coordinating probably the taxes affecting trade, but for domestic taxes, probably there's need to do some more engagements in order to bring about some harmony regarding the taxes. So, as I mentioned, these challenges of CET implementation, they have an impact on investment climate and regional market access. Because of the variations, these divergent measures can lead to, in some cases, to trade diversion and informal cross-border trade in order to avoid where there's a fear that probably to avoid the divergent taxes, other avenues are used for accessing the markets. Then also when it comes to duty remission, it affects the access of these goods or acceptability of these goods and the treatment when they are taken to other countries because of some of them. The reason is that there might be some risk. There's a risk of retaliation from other partner states just because there's the materials that were used to produce those goods were through duty remissions. So much as it's a delicate balance, because duty remission assists or helps in the procurement or utilization of low value inputs, but these are like short-term protection, which has other unintended consequences in the long term. So it's a very delicate situation which affects the investment and the trade environment. Now, for us, what we would advise as I conclude my presentation is that this webinar is going to provide a valuable opportunity to identify areas of convergence and divergence in the proposed tax measures in the coming financial year, so that there's a need to build the consensus on priority reforms. And we urge the private sector to push for structured consultations during this pre-budget cycle in order to harmonize positions regarding stages of application and remissions, so that it doesn't derail regional commitments. And we also urge you building consensus on joint industrial mapping to decide on products genuinely requiring protection, and also aligning incentives. For example, like now the countries have started providing incentive for electronic vehicles. So some of these ones need to be addressed jointly in order to come up with a common position. And finally, the Secretariat remains committed, as the Deputy Secretary General has mentioned, on working closely with partner states and private sector to advance a harmonized, transparent, and growth-oriented tax framework. Thank you so much.
Oh, thank you very much, Jonathan, for well-articulated presentation. And I think we will take into consideration your dialogue priorities for the private sectors. With the interest of time, I think it is high time to invite the PwC and we request we actually make it very brief, highlighting the key tax measures. Maybe from PwC, they can tell us maybe they're starting with which country. Our facilitator, please. Karibu sana. Welcome.
Asante sana, asante sana. Good morning, everyone. I hope you're all doing well. Allow me to
You are
turn on
very
the
far
camera
from the
very quick.
mic. Maybe I'm not sure. Please. Okay.
Sure, I'll try to project my voice more. How about now?
From my side, I can hear you now.
Great, great, great. So again, good morning, everyone. I hope you're all doing well. My name is Emmanuel Mlawa, a tax manager from PwC Rwanda. And together with me, there's a number of managers from other PwC offices, PwC Tanzania, Kenya, and Uganda as well, where we're going to walk you through the proposed measures that we think they should be considered for the finance bill and eventually the Finance Act that they are going to be released pretty much by the start of July in most of the countries in the region. Yeah. Now, without any delay, as I say, there's a number of managers that are going to be presenting. So to sort of manage time, I'll allow them to introduce themselves the moment they're presenting the proposed measures for their respective countries. But to start off our presentation, before we delve into the proposed measures that we think they should be considered for the reforms, would like to sort of present to you in a very high level the tax landscape to the 4 countries within the EAC bloc, and the countries being Tanzania, Kenya, Uganda, and Rwanda, so that you can be able to appreciate how the tax landscape really looks like for each of the countries. Yeah. And then after that, then we'll go and delve into the proposed measures. Now, to start off with the big thing, corporate income tax. Corporate income tax rate is pretty much the same, 30% in the 3 countries, with Rwanda now being the exception with the 28%. Now moving on to statutory contributions on the employer on the employer side, as you can see, the maximum or the highest is 10% in Tanzania and Uganda, while in Kenya and Rwanda is 6% right now. But I think the only difference that we can note there is in Kenya, there's the maximum and the lowest amount, the capping of the maximum and the lowest amount of contributions. And that is why we've highlighted it as nominal. While in Rwanda, although it's 6% at the moment, there is actually a law that has been passed, which will shoot this social security contribution or the pension contribution to 10% by the start of 2030. So pretty much by the 2030 will be Tanzania and Tanzania, Uganda, and Rwanda will be speaking the same language. And then moving on to skills and development levy and equivalents of that, we have Tanzania where they are charging 3.5%. In Kenya, there's actually a flat amount that is being contributed. That's why we've highlighted as nominal. While Uganda and Rwanda, there's pretty much nothing of that levy. Workers' compensation fund, or in other words, occupational hazard, we're having Tanzania 0.5% and Rwanda having the highest of 2%, and there's none in the remaining countries. And then we're also aware that there's other insignificant contributions, the likes of maternity leave benefit in Rwanda, the likes of affordable housing in Kenya. But yeah, we don't have to speak about them. Yeah, they're quite insignificant. But now to sum up on the statutory contributions on the employer side, you see that Tanzania is sort of leading with the 14% compared to the rest of the countries in the region. Moving on to same, employment taxes as well as statutory contributions. But on the employee side, you will note that Uganda is standing out with 40% maximum employment tax rate. And then the rest of the region pretty much are falling on 35 to 30% being the minimum. And then, as I mentioned earlier, social security contribution or pension contribution from the employee side, same for Tanzania, 10%, same for Kenya, 6%. Uganda is where it's coming at 5%, and then 6% for Rwanda. But as I said, it will be 10% in 2030. Maternity leave benefit, as I mentioned, is very specific for Rwanda. And then there's also some small contributions in other jurisdictions as well. So when you look at the employee side, Uganda is standing out with 45% effective tax and statutory contributions rate. Now, if you look at the pension contribution from both the employee and the employer side, Tanzania is standing out with 20%. But as I mentioned, when it gets to 2030, Rwanda will also be on the same rate of 20%. Now, moving on to the next slide. Thank you. Now, another thing I wanted to sort of highlight in a very high level is withholding taxes. And looking at that slide, one thing that you'll notice is pretty much our rates tend to sort of land on the same range with some peculiar situations like in Kenya. At some point it reaches to 30%, which is quite high. But now those instances are very few. But I think other things to sort of mention here is that in Rwanda, there's a bit of exemption. Yeah, as you can see, there's a lot of not applicable, and those exemptions are pretty much caused by the residence, the tax residency of the recipient of the payment here. So in Rwanda, if the recipient of the payment is a resident and their compliance in terms of income tax, then the withholding tax is completely exempted, and that's why we're having all those not applicable. But where you're seeing in other jurisdictions not applicable or a reduced rate, it's pretty much caused by the same thing, either a residency of the recipient of the payment, that's being one. Two, either the recipient of the payment is listed in a local stock exchange market, and pretty much that is what is causing the exemption or the reduced rate. Now, one or two things that you can also note is that in Tanzania and Kenya, there's actually withholding taxes on digital content creators that pretty much falls under 5%. And in Kenya as well, it falls around. Sorry, Rafael, if you can go back to withholding tax slide. Yes, and in Kenya it falls around 5 to 20%. But one thing that is very, very different from the rest of the countries is that in Tanzania there's new introduction of withholding taxes on the transfer of digital assets, transfer or exchange of these digital assets, and this is sort of aimed to charge withholding taxes on transactions of maybe cryptos and the likes. Yeah. Now, moving on to VAT and excise duty, you will note that we are fairly the same. All the four countries in the region, we are around 18%, with Kenya being exception of 16%, and Tanzania, Zanzibar being exception where they apply 15%. Moving on to export, we're all aligned. We're all sort of encouraging exportation, and that's why we are on 0% tax, VAT on exportation. Yeah. When it comes to excise duty, you'll appreciate that excise duty in most of the countries tends to put a specific rate for a specific good, and that is why we've put it as several. So they're being addressed in the excise duty laws of the specific countries, and there are a number of them. But when it comes to services, we wanted to highlight here a little bit of them. And the interesting ones are the ones that are applied to telcos, telecommunication companies. So a lot, I mean, 3 countries within the region, yeah, Tanzania, Uganda, and Kenya, there's excise duty on bundles and airtime, but there's also excise duty on mobile money transfer. Yeah, with exception for Rwanda, where there is excise duty on airtime, but there is no excise duty as it stands right now. There's no excise duty on mobile money transfers. However, as I mentioned earlier, there's been a number of reforms that happened, and those reforms they are intending to introduce I think around 15% of excise duty sometime around 2028. But we'll cover that when we're talking about the proposed measures. And then moving on to financial institutions, there's also excise duty to almost all the countries, with Rwanda being an exception. But as I mentioned, that reform that is coming to introduce excise duty in mobile money transfers, it will also cut across also fees and charges that financial institutions will be charging on the money transfers. Moving on to the next slide. Yes, so now one thing we also wanted to highlight is the budget process, because yeah, I mean, as you know, this whole webinar is pretty much about the budget and the reforms that we are sort of pushing for them to be considered. But now, before we go to that, we think it's sort of wise and good to sort of bring you to what is the budget process within the region, within the 4 countries. And to be specific, 3 of the countries, yeah, Tanzania, Uganda, and Kenya, the process is fairly the same, where in each of the countries, they start with submissions to the Minister of Finance. And then after submissions, engagements start, where if there's need, some discussions about the submissions that you've submitted, they go through, and then after discussions, there is when a sort of difference comes in. In Kenya and Uganda, the finance bill gets released very, very early, I would say, if you compare to Tanzania. So the finance bill in Kenya and Uganda is generally generally released around March and April, where now it leaves another room of like a month or 2, where the stakeholders sort of discuss with the National Assembly and Parliament members on those proposed measures that came with the finance bill. And then, I mean, some of them get to be taken on board, and then the budget reading comes, and then eventually the Finance Act, sometime around the start of July. But the difference here is that in Tanzania, that finance bill tends to delay a lot. It sort of gets released sometimes mid-June, which leaves a very, very small window for engagements and discussions with the respective people, our responsible people, to sort of address those finance bills. And you can also imagine that some of the changes that have been proposed in the finance bill, they will require companies to sort of invest time to change their processes and stuff like that, to be able to comply with those new reforms that are going to be the law, or to be enacted in the law by the 1st of July. So you can imagine companies are left with only 2 weeks fairly to sort of do that, which is one of the things that in Tanzania it gets addressed a lot, to sort of ask
Mr. Emmanuel, can
the finance bill to be released early.
Because of
Yes.
interest of time, I think you can move quickly and summarize. We move to a specific country presentation.
Thank
Please.
you. Thank you very much. Yes. So now to finalize is that just 2 differences is that in Tanzania, there's another arm where there's a presidential commission that it also sort of was sort of brought to sort of take stakeholders' comments on the law. and then to sort of address them or provide recommendations to the president so that president can push for adjustments in the law. And in Rwanda, the process is fairly different from the rest of the countries because the way the law change here is it's not on annual basis. Here, the law tend to take maybe around 5 years before it gets amended. But when the law is about to be amended in Rwanda, the process is also fairly the same, where you'd find the proposed amendments, they sort of announced, and then the moment they're announced, some engagements may happen about them, and then later they get to be enacted to a law. Now, without wasting time, I'll invite my colleagues from PwC Tanzania to talk about the proposed measures in Tanzania. Over to you, Diana and Rafa.
Thank you, Emmanuel. And by way of introduction, my name is Diana Katemba. I'm a tax manager from PwC Tanzania. And yeah, without wasting time, let me go straight to the various proposed measures for Tanzania. And yeah, so starting with the measures in relating to tax administration. So the first proposal is that is on the budget process. So what we are saying here is that there is not enough time from the time when the finance bill is out to when the implementation of the Finance Act begins. So for Tanzania, as how Emmanuel has briefly explained, we barely have less than 2 weeks for this whole process and for the stakeholders, to review the finance bill and make proposals or comments. And therefore, this is not enough. And therefore, our proposal is to, mirror what our neighboring countries have. So the likes of Kenya, which has like 2 months, and this, allows stakeholders to get enough time to participate in the whole process. Another proposal is on the timeline for provision of information to the Revenue Authority. And here we are proposing that we add more days to 30 days and an avenue to apply for extension of 15 days, so making it a total of 45 days. So what we have currently is 14 days to provide information to the tax Revenue Authority with an avenue to extend 14 days more, so making it a total of 28 days. But then, with TRA now evolving, requesting difficult reconciliation, it's difficult for taxpayers to, respond comprehensively within 28 days. Another proposal is on the interest accumulation during dispute resolution. So again, as we understand, the dispute resolution tends to be a bit lengthy sometimes, and especially when it comes to appellate bodies. And therefore, it's a bit punitive and unfair to taxpayers to be charged late payment interest while the dispute resolution sometimes is not in their control. So our proposition is to not accumulate late payment interest during this dispute resolution, so that it allows, a fair position for the taxpayers. In terms of Income Tax Act, our proposal is on the provision of guidance in the application of the deemed distribution dividend provision. So this came last year with Finance Act 2025, and the provision requires, gives the discretionary power to the Commissioner General to deem 30% of the profits of an entity as being distributed 12 months after the end of the year of income, if the entity has not made any distribution during that year. So now there are a number of contentious issues, and especially that this provision came as an tax avoidance provision. And the expectation is that the Commissioner General would only invoke it in scenarios where there exists, motives for tax avoidance. Now, with how it's drafted right now, it's not clear under what scenarios or what conditions would the Commissioner General deem that there is a motive for tax avoidance by the taxpayer. So again, we need clarification from the government, and we expect that the government should provide more clarification in this aspect. Another proposition is on the foreign exchange. So how it is right now, the taxation is based on realization. But however, our proposition is that this should only apply on long-term loans. And the reason is there should be excluded the day-to-day transactions, the working capital. And this is because it adds another layer of, administrative burden to the taxpayers to keep tracking the realization of the day-to-day transactions. So maybe just, apply it only on long-term loans rather than the normal working capital items. Another provision is on the bad debt write-off. And this is something that has been there for some time. And what we're saying that here is that for corporate income tax, for you to be able to claim deduction in the tax computation, you need to make sure that you have proven that there exists reasonable steps. You have gone through reasonable steps for you to be able to write off the bad debts. Now, the law has not defined clearly what qualifies as reasonable steps for somebody to say that now I can write off my bad debts. So at some point, the minister had announced the publishing of the regulations, but this has not been done to date, and therefore calls for a more looking into this by the government so that it becomes clear. In terms of skills and development levy and workers' compensation fund, so here we are proposing a reduction of the skills and development levy from the current rate of 3.5 to 2.5. And then this can then be allocated to the 2% goes to VETA and the 0.5 to workers' compensation fund. So this in general would reduce the employer's costs and then also abolish, the compliance obligation for the employers having to comply separately for workers' compensation fund and skills and development levy. And then, it also exempt the small and medium enterprises from paying the skills and development levy. In terms of VAT, I would welcome my colleague, Raphael, to proceed.
Yeah, so thanks, Diana. Hi, ladies and gentlemen. So my name is Raphael Viamongo. I'm a manager in the tax function of HPWTZ. So in my case, I'm just going to touch on the indirect tax bits or on the proposed changes and specifically on the VAT and excise duty. So you'll actually appreciate that this particular type of tax are not only just technical instrument. Of course, we actually consider them to be levers that actually influence investment, be it consumption, and of course, ultimately the growth itself. So I'll actually focus on some of the proposed clarification. Of course, the list is not exhaustive, that we believe that it can actually help to strengthen both compliance and of course, bring economic opportunity. So first, to begin with VAT, the first one is with regard to the VAT deferment of imported capital goods. So you'll appreciate that back in 2023, the government took initiative to expand tax base by actually granting VAT deferral for the local manufacturing capital goods, of course, with the specific HS code. Now, in addition to that, the finance act changes actually brought, or rather proposed that the VAT deferral for the imported capital goods to cease its application in June 2026. Now, as the current cessation date of June 2026 comes into an end, there is actually a risk that they'll actually be discouraging long-term investment. Of course, for us, we believe that removing this expiry ensures that there is predictability for businesses actually making the capital investment decision, as we believe that investors need certainty and of course not just sunset clause in the provision of the law. Another change, it's with regard to the definition of entertainment. We have seen, of course, there have always been back and forth on what entertainment has been defined in the provision of the VAT Act. So at present, there are some of the ambiguity, of course, in relation to the law prevents legitimate claims of staff food and, of course, accommodation in remote areas. So we believe that in clarifying this definition, we will recognize the reality of industries operating far from urban areas and of course to support their workforce at large. Another change is with regard to the electronic supply services. Of course, we have seen initiative took by most of the East African countries back in 2022, requiring non-resident supplying services to the non-registered person, be it businesses which are actually not VAT registered and individuals. And in this particular case, we see challenges where digital platform have actually been increasing mediating apps and of course contents. So clarity needs to be needed on who actually bear the VAT responsibility. Is it either the supplier or the platform itself? So in this particular case, we actually see this is that it's just not the legal technicality, but rather it's all about aligning our tax system with the digital economy. Another change with regard to the VAT, it's in relation to the intending traders. You'll appreciate that as far as the VAT Act of Tanzania is concerned, one can register for VAT by various ways, including registration by way of intending trader for traders who actually expect to make taxable supplies in future. So you, in this particular case, we see that by allowing them to claim input VAT and of course granting refund, it actually aligns with the VAT principles and it eventually encourages entrepreneurship. And we see this to be the matter of fairness and consistency rather than actually locking out the cash from the government's end. The last one is the specific in relation to the transportation businesses. We believe that we require clarification on the VAT treatment of subcontracted transit services because we believe if you actually speak about the export of goods, the same should be zero rated, be it either directly done by the contractor or if the contractor chooses to subcontract to other companies. So in this particular regard, we actually see that there needs to be a clear definition on what subcontracted transit services either be treated by as part of the international transportation. So in this particular case, without this, we actually see the risk of double taxation and the increase unnecessary cost in the regional trade. Another changes, and I'm going to go quickly in relation to the excise duty. And the first one we have is actually the enactment of the new excise legislation. So this legislation, of course, was first introduced back in 1954. And of course, we appreciate that there have been some of the various amendments that was being done in the law, but we still believe that the current excise framework must be updated just to reflect the today's consumption pattern and technologies. And in this particular case, I'm actually going to give a good reference in terms of the second point that I'm actually speaking about. So we have a general provision in the VAT, in the Excise Duty Act, that actually speaks about the excise duty should not be levied in more than once in any scheduled articles, and specifically this is section 130. So the current act actually is arranged in such a way that only goods that actually form part of the scheduled items are actually subject to this provision. That is, they shouldn't be subject to excise duty in more than one stage. But in this particular case, we have seen instances where services are imposed under the main section of that particular act. Now, this is actually a critical provision, and of course, it helps prevent double taxation. However, due to the limited reference in that particular provision, specifically the scheduled articles, it actually creates an environment that actually have fostered disputes between the taxpayer and the tax authority at large. And of course, in this particular case, we have seen situations where tax authority seek to subject services to excise duty. Now, you'll actually see that if this is actually not made clear, intermediaries specifically are actually subject to excise duty. So if the proposal is that excise duty should actually be removed in the intermediary services, and if this is not the case, then there should actually a clear set of offset mechanisms, because excise duty, similarly to VAT, it's a consumption tax. And in most cases, the taxpayers would not want to bear this burden and eventually pass it to the final consumer, leading it to the increase in cost of that particular services. Now, coming to another change, it's a call for the balance policy, as it actually set to expire this particular year. So back in 2023, there was a proposal that excise duty will actually be relooked. Of course, the provision was amended from shall to may, and in this particular case, as the 3-year time limitation comes to an end, I think it's the best time for the policymakers to consider stakeholders' perspective, of course, alongside key microeconomic indicators before making any decision on adjusting the excise duty. And the last but not least, it's the reduction of excise duty on the electronic communication services. Emmanuel had presented earlier the regional comparison, and if you look at the regional comparison itself, Tanzania is actually charging a higher excise duty rate of 17%. Now, in this particular case, we actually see that reducing excise duty on electronic communication services, it will actually help to broader penetration. Of course, as much as yes, one would argue that the tax base, or rather the tax, will decrease. But eventually, if you look to various publications, the same will actually eventually yield to the increase in GDP per capita in a long term. So those are proposed changes for Tanzania. I would welcome my colleague to proceed with the changes for Kenya.
Thank you very much. Okay, for Kenya, please make sure you become very brief, because the time is not our best ally. Karibu Kenya.
Thank you. So for Kenya, in terms of income tax, the first proposal is on the increasing the tax loss carry forward limit from 5 to 10 years. So as it stands currently, the tax losses can only be carried forward up to 5 years. So the proposal here is to increase it to 10 years, especially for sectors that have a long gestation period. Another one is on exclusion of non-cash items in calculation of repatriated income. And the aim of this is to ensure that the taxation is only on the actual profits being repatriated, and rather than the non-paper profit. Another one is on the removal of the minimum threshold of Kenyan shillings 5 million annual turnover to trigger the significant economic presence tax. So as it stands, this threshold has been removed. So the proposition here is to have alignment between the significant economic presence tax laws with the VAT thresholds, so that there is clarity and consistency. In terms of employment tax, the proposition is to increase the tax-free thresholds and widen the bands, so that it eases the burden for the low and middle income earners. Another proposition is to restore the pension and death benefits exemptions, and this is to ensure that it upholds equity and fairness in taxation. In terms of tax administration, here the proposition is to extend the withholding tax remittance. So currently it stands at 5 days after the end of the month, and the proposition is to have it to 20 days after the end of the month. And then another one is on the deemed approval for tax exemptions. And here the law provides 90 days for the commissioner to issue the tax exemption certificate. And then the proposition is that if the commissioner has not responded within the 90 days, then there should be a deemed approval of the tax exemption for the taxpayer. In terms of value-added tax, I would welcome my colleague.
Yeah, so I'll proceed on the proposed changes for VAT, and the first one is actually in relation to the transactional clause in relation for the VAT refund. So in this particular case, you'll actually appreciate that the Finance Act of 2025 reduced the VAT refund application window from a period of 12 months to the 24 months to 12 months. Of course, in the sense that time-bearing claims between the 13th and 24 months will actually be rejected. So for us, we actually see it's very important introducing a transactional clause that will actually help to cure this shortcoming, and of course to protect the taxpayer from unfair exclusion, because VAT refund, you will actually be rejecting the VAT refund just because of the time limitation. Another proposal is with regard to the non-resident digital suppliers. Our proposal is that there should be removal of the mandatory VAT registration for the non-resident suppliers of imported digital services. In this particular case, we actually believe it will help to simplify compliance and, of course, reduce any administrative burdens, of course, while ensuring that Kenya still captures the revenue from the digital economy. The other one, aligned with the best practices, of course, our neighbors, Tanzania, in this particular case, is just the removal of VAT rates from the energy product, which is actually critical. And of course, we have seen situations where high rate actually increase cost across the economy. Of course, in this particular case, we actually call for a balanced approach that can actually help to support households, of course, and businesses while helping to maintain the physical stability, and specifically just the VAT rate itself, because some of our neighbors actually do not impose VAT on fuel or petroleum products, of course, with the specific HS code as indicated in their relevant legislations. Another one is with regard to the bad debts refund. We call a reducing of timelines for lodging VAT refund of bad debts. And of course, we believe in this particular case, it will help to ease the cash flow pressure from businesses, especially in the sectors prone to the delayed payment. The other one is with regard to the registration threshold. So we call our call is that we actually call the government to revisit the compulsory VAT registration threshold, which is actually currently set at 5 million Kenyan shilling. So we believe if this is revisited, of course, it's increased to help to ensure that compliance obligations are actually appropriated to business sizes. And the last one is with regard to the exempt and zero-rated schedule. We actually call a proposal just to clean up these schedules and limiting them to the zero-rated just to encourage export, and as we believe it will help to simplify administration and of course aligning Kenya's VAT regime with the international best practices. For the excise duty, it's one of the key that we actually saw should be highlighted. It's actually amending the definition of other services as how it is captured in the Excise Duty Act to exclude charges by savings, of course, and cooperative organization to their members. We actually believe this is actually fair and logical because SACCOs operate in a principle of mutuality. Now, if actually taxing member-to-member dealings, it actually undermines that doctrine. Now, aligning the exercise with the principle of mutuality, we believe this will actually help to strengthen cooperative finances and actually support financial inclusion. So, in conclusion, these are actually proposals that we believe are not about reducing government physical capacity. They are all about building the tax system that is predictable, equitable, and of course growth oriented. So I'll actually pause here for the Kenyan proposed changes and actually welcome my colleague from Uganda.
Thank you very much. Uganda, please, quickly.
Thank you very much. Good afternoon, everyone. My name is Patricia Chigundu, tax manager in the PwC Uganda office. So just quickly, just overall in respect of the tax amendment bills, it's basically just to grow the revenue bracket, considering that we've come out of elections and there's a lot of pressure to have these revenues boosted. And that's basically the intention of most of these amendments. Just moving on to the tax procedures amendment bill, there is a proposal to reduce the fixed penalty for people who possess goods and they're lacking digital tax stamps from 50 million to 2 million. And basically, as you may be aware, the current penalty is about 50 million, which has basically been a deterrent. And we've had a number of downtown people, as we call them, the Chikubo, making a lot of noise. And it's been difficult for the Revenue Authority to impose, especially for people who have small transactions. So now this proposal is basically just to help balance out this enforcement and also remove that burden mainly on the small traders. The second proposal is basically to the waiver of interest and penalties. If there is any tax, including penal tax and interest owed by a taxpayer as of 30th of June 2016, and it's been outstanding as at 1st of July 2026. So this is not the first of the waivers that we've had. We've had them since COVID 2020, and each year gracefully we've been having these waivers being granted by government. But again, whereas we've noticed that there've been a number of challenges with the URA allowing, or Revenue Authority allowing, for a number of these waivers to be implemented on their ledgers, and basically them imposing taxes nonetheless. We have basically suggested to members of parliament or the committee that is looking at these bills that they should actually look at the period to be extended as of 30th of June 2021. So that as of 30th of June 2021 to basically 1st of June or 30th of June 2016, everything should be cleaned out. So we hope that that proposal is passed. The third one is basically an introduction of a fixed penalty in respect of non-use of physical devices. And what the penalty is the higher of the double of the tax due on the goods and services, or 2 million. And basically the same has also been done if a taxpayer doesn't issue an e-freeze invoice or e-receipt. Now, again, pressure to have the revenue boosted. These penalties, it's not the first. We had one in the previous year, and this has also been increased. So we find that, again, as already mentioned, that URA or the government is really trying to impose penalties and expand the revenue bracket. So moving on to income tax. Income tax, interestingly, has had, next slide. Next slide, please. Okay. So income tax, interestingly, has had a number of amendments, and I'm sure you'll hear a number of debates on the changes that are being proposed, with the Revenue Authority targeting about, I think, 410 billion in respect of changes in the income tax amendment bill. The first one being the amendment to expand the definition of royalty to include any payment made as a consideration for the use or the right of use of software. Now, this also we feel is a challenge, because once this change is passed, which we feel is a significant change, the payments of software will be categorized as royalty, and consequently they will be subject to withholding tax if that is passed. The proposal has already been made to the parliamentary committee not to consider this, and let's wait to see what will be passed. The second proposal is to exclude the application of 5% digital service tax on royalties. And this implies that if royalty payments are being made to a non-resident, then the normal rate of 15% will apply. Now, again, it's to boost the revenue, the revenues that government is looking at, to ensure that as opposed to the 5%, the 15% is imposed. The third proposal is to introduce tax as I think it's just across all the region, is to introduce tax of 0.5% on the gross income of a taxpayer, or 30% of chargeable income, whichever it's higher, where a taxpayer has been carrying forward losses for a period of 7 years. Now, this proposal is going to be a challenge, and our proposals to government has been that they should not implement, or they shouldn't pass this proposal, simply because that if you're looking at a loss-making entity, there is already a capping of losses to 50% if someone has consistently been in losses for 7 years. And our submission has been that this will definitely affect capital-intensive projects, typically who incur these losses in their early years, and they take long to just realize profits. So our proposal is they should just basically not implement this tax in its wholesome proposal. The next one is to introduce the 6% withholding tax obligation for a person who purchases a non-business asset. Now, this has also caused a lot of noise. Why? Because here government is looking to tax personal assets. We're talking of things like land, jewelry, as mentioned by URA or the Revenue Authority, which we feel, which they shouldn't be doing that. It's going to be difficult for them to impose. But then more importantly, they have not defined what non-business assets are. So our proposal to government is they shouldn't consider this proposal. The next one is a quick one, is to allow the microfinance deposit-taking institutions, or the Tier 4 microfinance institutions, to claim bad debts. This way, it's a welcome amendment, so that it basically puts them in the same bracket with other financial institutions. Moving on to the next slide. Again, we are seeing a proposal to broaden the 10%, to broaden the bracket in respect of mobile money services, where the government is saying that if a telecom communication service provider like MTN is paying a commission for retail services and mobile money services, then they should be withholding tax at 10%. Of course, this is with it's to expand the tax bracket, and we are waiting to see how this will be implemented, as it has posed a challenge in the past. The next one is a proposal to include tax withheld on commissions paid to an insurance agent and commissions to telecommunication services as final tax. To us, this is a welcome amendment, and it shouldn't have any issues if passed. The third one, as you may see there, is the bill also is poses to introduce 6% withholding tax on a resident public entertainer. Now, that is a little bit of a challenge because the bill as we speak has not defined what a resident public entertainer is, which means that if I post a TikTok video, I may be seen to be a public entertainer. So we will wait to see government clarify what they mean by a resident public entertainer. The next one is the bill. The bill is proposing that foreign source income derived by a resident individual should be taxed at the same rate as income sourced in Uganda. Now, basically, this is just to rationalize so that resident individuals are not subject to 40% generally, the income tax rate on their worldwide income, which we believe should be a welcome amendment. The fifth one is the bill seeks to introduce 5% withholding tax on interest paid by a resident company to a non-resident financial institution of public character. Now, this is going to be a challenge, especially for most banks. One, it's going to discourage capital investment, and those are one of the propositions we've made to government. We are saying that it's going to impact foreign exchange stability. It's going to increase the cost of borrowing. So our submission to government is basically this proposal shouldn't be passed, but we are waiting to see what the debate will look like. The next one, which is the final one, is basically we are seeing that the resident individual rates for pay-as-you-earn purposes have been amended, and this is since 2012. So there is a net saving of about between 10,000 to 13,000 Uganda shilling, depending on where the individual's gross employment income falls. But we believe this should be a welcome amendment. And of course, other industries are saying that government can do better in terms of giving a net saving back to the public. So the next one, so basically that pretty much covers what is covered in the proposed proposals under income tax. Under stamp duty, generally the feel is again government is scooping for money. There is a proposal or a requirement for financial institutions to start filing monthly stamp duty returns on all sums, and non-compliance would attract interest at 2%. Now, that's going to be a challenge for a number of financial institutions, as you may be aware. Of course, the intention of government is basically to just give visibility of what these financial institutions are filing and ensure that they are accounting for stamp duty. If passed, there's going to be a burden on financial institutions to make sure that they are compliant. But our proposal to government is that they should just stick to transactions which the financial or banks are part of, and not every transaction, because it's going to be burdensome and very administrative for them to do. The next one is the bill that introduces the requirement to retain documents and records for 5 years. This is a welcome amendment because it aligns with the other acts, like the Income Tax Act, that requires the retention period of records to be 5 years. The third one is in respect of stamp duty. You might have heard a lot of noise about it. Government intends to increase stamp duty on transfer of an asset from 1.5% to 3% on the total value. Now, this is going to be, it's still being debated. There are many sentiments around it. For instance, if I'm transferring a piece of land and they're saying that the stamp duty rate is 3%, it's going to pose a challenge. And of course, we are waiting to see what the members of parliament will speak on it, but hopefully it's not passed. The last one is in respect of introduction of stamp duty on automobiles. Motorcycles, what we call here the borders. There's a proposal to introduce stamp duty of 50,000. Of course, they're already up in arms that this tax is high. But also our proposal has been that for motorcycles that sort of reserve energy or they reserve the environment, or electronic motorbikes shouldn't be included in this category. And we hope to see what government says about it. And any other motor vehicle, 200,000. So that's it from a stamp duty perspective. I will allow my colleague Nicholas to speak on VAT. Thank you.
Thank you so much, Patricia. I know our time is fast spent. So regarding VAT, I'll just highlight the few. There are quite a number. There are almost about 10 proposals that are being proposed as measures by the government. So first of the list is a proposal to increase or revise the VAT registration threshold upwards from 150 million annually to about 250. So on a quarterly basis, the current threshold is 37.5 million shillings. They intend to increase that to about 62.5. This means that this will lock out quite a number of businesses, and this measure really needs to be considered. Maybe it needs to be introduced in phases, regarding the amounts of uplift. And then the other measure that they're looking at is extending the deferred VAT deferment for inputs that are used, especially in the mining sector. So currently, it's only the suppliers, manufacturers that are importing plant and machinery that are benefiting from this concession, but they intend to extend it to the mining sector, which is really a welcome amendment as it sort of boosts the mining industry. The other bill is really to align in terms of doing away or exempting withholding VAT on payments for suppliers where you've received an IFRIS invoice. So I think this is a welcome amendment because it saves a lot of time administratively, and also in a way it gives a bit of cash flow to the people that have been suffering this 6%. Because if someone is already registered for VAT and issuing IFRIS invoices, then you already have those people on the register, so it wouldn't be a really of any benefit in trying to give them another additional administrative burden. The other measure is, the bit where they are trying to revise downwards the threshold for individuals to or non-registered VAT persons to be able to or to be eligible to claim input that has been incurred on goods where they've received the free invoices. So ideally, this was initially brought in to sort of encourage people to request for IFRIS invoices, and by doing so, it was viewed that the public would go ahead and try to purchase as much as they can, and also put pressure on the suppliers to issue IFRIS invoices. But because the threshold is currently at 5 million, it has been a bit of a challenge for people because there are very few people or persons that can be able to purchase items worth 5 million. So they are lowering it to 2 million to encourage them to do that. The other one is trying to introduce, for the developers in the hoteling industry and tourism, trying to give them a concession to be able to claim the input of up to 2 years prior to launching that hotel that you've constructed during that period. So currently, they don't allow any such individuals or persons that are developing hotels to claim that input that is incurred during the construction phase. However, now they are trying to extend it so that they promote that in view of the upcoming Africa Cup of Nations in 2027. They want to boost the tourism industry. However, the challenge here is that we have a threshold of 5 million, the threshold of 10 million for the foreigners, and a threshold of 5 million for the citizen. This is really a bit high, considering that the current exemptions that we have for other people in agribusiness, in other sectors, for a citizen, it's about 300,000 US dollars. So our proposition to the government is to try and lower this to align it to the current threshold, so that they are able to encourage people to invest in that. Next slide, please. Yes. So the other measures, when you look at excise duty as a part of the indirect taxes, as Mr. Simon Kaheru mentioned earlier on, there's been a number of pressures that are rising from the geopolitical wars, especially we had the Israel on Gaza war, we had the Ukraine and Russia war, then we had recently the Iran war, which has increased items, logistics prices, and movement of goods has been made a bit difficult, which has led to increase of prices within the country, especially Uganda being a landlocked country, suffered a lot in the increment of the prices. However, from a government standpoint, they intend to increase quite a number of taxes. I'll just mention a few of them. One of those is the undenatured spirits, where they're looking at increasing the excise duty on that from the current 1,700 and 60% from a volume perspective to 80% and 3.5. So this, in a way, is an increase that is considered to bring in a bit of revenue to the government. However, when you look at it from our perspective, it should be a welcome amendment, because again, it sort of leads to at least curbing the competition with the local market, given that we have quite a number of local suppliers and local manufacturers of spirits. Then cement, there's proposed increase of excise duty on cement from the current 500 shillings per 50 kgs to upwards to 1,000 per 50 kgs. This is really a bit, challenging, considering that, because of the effects of the increment in the prices of transportation, we've had cement almost go upwards from about 29,000 Uganda shillings in the month of February to currently about 36,000 already, even without introduction of the excise duty. So we view this that in the event that it's passed into law, it's going to be a bit create a bit of a tumbling block for people to be able to invest in construction. Similar to that, we have the proposed increment of prices which might arise from the proposed increase in the excise duty on motor spirit and gas oil by 200 shillings, which again is viewed as going to have a detrimental effect on companies, manufacturing firms, because companies use a lot of diesel to operate many of their machinery. We have the transporters, we have even the normal people that motorists that are using a lot of fuel to get from one point to another. So this has a detrimental effect to how business is going to be done, because it's going to likely increase the prices of the commodities. Can we go to the next page, please? Okay. The other proposed changes in respect to sugar, cooking. Apologies, I'm having a bit of network glitch. I hope I'm back and audible. You can hear me. So we have a bit of challenge coming from these proposed measures, and we've proposed to the government to at least look at revising these rates at least to mirror the inflationary adjustment that has happened over the past course of the financial year, so that then we can align in terms of increment, as opposed to doing 100% on each of these. And in some cases, you see the proposed increment is about 150%. Could we please go to the next page? Thank you. Next slide, please. Hello. Yes. So lastly, we have the external trade amendment bill. So last year we ushered in the import declaration fee. The idea is that the government wants to extend this at least to the medical supplies, vaccines, medicines, pesticides, rodenticides, and insecticides. The other one is this, of course, is a welcome amendment because it helps people that are dealing in that and also the agriculture sector. The other one is that the bill proposes to increase the environmental levy from 15% to 30%. On the instance. Apologies for that. I was speaking to the second-hand clothes. So the bill proposes to revise the environmental levy to about 30%. Again, here our ask to the government has been that this should be done at least in view of the inflationary adjustment, and we consider that would be a bit more reasonable. Otherwise, this is likely to increase the costs of doing business for people that are dealing in such clothes. With that, I think I would like to invite my colleague from Rwanda to take us through the proposals. Thanks.
Thank you. Now, because of interest in time here, I'll run really fast. So for Rwanda, as I explained in the introductory part, is that we do not have the usual and normal structured finance bill and budget process. So for the purpose of this presentation, we're going to walk you through the major and comprehensive tax reforms that happened last year around 2025 and what has been enacted from that. And the good thing is that a lot of the reforms that happened, they've been phased to sort of come into effect in different years. So we're going to walk you through that, but only focusing on the material ones. Moving on to the next slide, Rafa. Yeah, so I think few major things is that capital gains tax rate, which was 5%, has been doubled to 10%, and it used to apply only on shares, transfer the capital gains that resides from the transfer sale of shares, but now other tradable assets and similar assets, they're also included, the likes of license, debt instruments, options, and guarantees. And then moving on to the second one is digital services tax. So we had, digital services, or rather businesses that are conducting their services digitally without the local presence in the country, they were captured for income tax and VAT, but we didn't get to know more about it. But the reforms introduced 1.5% tax on their gross revenue sourced from Rwanda. But again, we're waiting for the ministry order that will come with modalities of how that is going to be complied. Again, we also have, we had a VAT exemption on ICT services and equipment, but that one has also been lifted. And moving on to the next slide. Next slide, Rafael. Yes, so on excise duty, as I mentioned earlier in the introductory part, is that we're having an increase on excise duty on airtime from 10 to 12, and eventually it's going to land to 15%. I think by 2027, you will see that. And then I'll skip the two because they're sort of immaterial. Moving on to next slide, Rafael. Yes, so few more material things is that there's been introduction of tourism levy, 3% on the accommodation fee. And the essence really is to sort of align with the rest of the countries in the EAC bloc. And then on gaming activities, we've seen an increase of gaming tax from 13% to 40%. We've also seen a withholding tax on the winnings that are payable to the winner, yeah, to the person who places the bet from 15% to 25%. And the justification here is that to sort of discourage gaming activities because of the socioeconomic impact it has to the population. Again, we also had exemptions of import duties and all the taxes when you're importing hybrid vehicles, but now all that has been lifted, and it's only exemption on import duty that still stays, but excise duty, VAT, and withholding taxes now applies on importation of hybrid vehicles. Next slide, Rafael. Thank you. Now, we also had an exemption on VAT on transportation of goods, but that has also been lifted. Now, for the ones that are going to take into effect in the next financial year, 26-27, moving on to the next slide, Rafael. Yes, so among those reforms, as I mentioned, some of them they are going to take into effect in the next financial year, 26-27, and as well 27-28 and 28-29. So for 26-27 is that we had VAT exemption on importation of capital and raw materials, but that has been lifted. And as I mentioned as well, excess duty on airtime, it was 10%, but it has been increased all the way to 15%, but it has been phased. So from 10 to 12, 12 to 14, and 14 to 15%. Now for 27-28, as I mentioned on the introductory part, is that we do not have excise duty on money transactions, money transfer fees, but it's going to come around 27-28 and at 15% on the commission and fees charged on the money transfer. So it will pretty much affect mobile money as well as the bank charges on the transfers as well. And as I mentioned, excess duty, so I'll skip that. But we also have pension contribution. I believe I also mentioned this in the introductory part, that it was 6%, but it's going to go all the way to 10% in 2030. But in 27-28, it will go to 8%. Moving on to 28-29 is that electric vehicles as well, apart from hybrid vehicles, electric vehicles, they're also exempted from all the import duties and taxes. But in 28-29, the VAT exemption on those electric vehicle, importation of electric vehicles will be lifted, and then they will start apply VAT on that, and as well as energy supply equipment as well. They are also exempted from VAT as it is right now, but VAT exemption will be lifted in 28-29. And then 29-30 is now the other reform that I mentioned on the pension, that it will move now from 8% to 10% by 29-30. So I think that's it from the Rwandan side, and I will hand it over to the team in EABC. Over to you.
Okay, thank you very much. I think we have had the presentation. Please, if you have any question, raise your hand and be very specific where you are directing your question. If it is for presentation from the EAC Secretariat, the general presentation from Emmanuel Mlawa, or the country-specific presentation. Please, make it very quick. And if you have any question, please raise your hand and ask question. We have. Hello? Yes,
Hello?
Najuna, right?
Hello?
Yes.
Hello? Ask your question,
Hello?
your name and question.
Hello. Yes. Good afternoon, everyone.
Good afternoon.
Good afternoon.
Hope everyone can get me here. My name is
Yep.
Najla Bright, and I'm program at East African News Network. Thank you for all your presentations. My question goes to the person who have presented Uganda. I didn't hear him or her talking about the ongoing income tax proposals. That is on personal income tax changes that are happening apparently. Thank you so much. And also on, I wanted to make a submission on exercise duty on communication and telephones. I think I'll do submission. Because of time, I can't do submission now. Maybe I'm going to use the chat. I beg to submit.
Thank you very
Hello.
much, Brighter. Yes, another
This
inquiry.
This is Richard Mahulo from Busia Cross Border Traders Association, Kenya. I'm the person coordinating the small scale traders. And my question goes on harmonization and implementation. What specific tax measures have partner states agreed to harmonize for the year 2026 and 2027? And what is the timeline for domestication? Thank you.
Okay, that one you are directing to EAC Secretariat or to who?
Yes, I'm directing to EAC Secretariat.
Okay. Another inquiry, please. At least we can have 3. Okay, if there is no other question, there is also another inquiry regarding the presentation from Kenya. The first one is actually related to VAT, where the proposal is to review the VAT rate on fuel and the petroleum and energy product. And is not actually wanted to know the concrete review in terms of increasing or decreasing, and what is how much. Another proposal is change of compulsory VAT registration threshold, where they say currently is Kenya shillings 1 million. What is the proposal in terms of the amount? And the last one is on clean up of the exemption and the zero rating shadows for the actually relate where they are saying it should be limited to zero rating only on export. So from Kenya, do you want all the exemption be eliminated on VAT, as well as all the zero rated eliminated, and we remain only with export? Those were also the inquiries which we have received. So we are requesting, we start with EAC Secretariat to make to respond to the cross-border, who they are asking the scope and the area of harmonization. Then we come to Uganda as well as Kenya.
Thank you, moderator. What I can say that discussions on harmonization of excise duty are still going on.
Okay.
And the process has not yet been finalized. So it's still an ongoing process. So the identification of commodities is still going on. So that's what I can say for now.
Sure.
Thank you.
Okay. From Uganda, Chigunda, is it Chigunda? Sorry.
Chigundu. But
Chigundu, okay.
yes, thank you very much, and thank you for the question. We actually did talk about the personal income tax bans for the resident individuals like myself. So basically, just to explain it a little bit further, where we say that there is basically a net saving of in between 10,000 to 13,000 across the bands. So the specific things that or specific changes are that if a resident individual is earning a gross pay of more than 335,000, they exempt from pay as you earn. Initially, it was 235,000, but now that has been increased from 235 to 335,000. So if someone is earning that per month, then they're exempt from pay as you earn. The second one, what the intention of the bill was, is to eliminate that 10% individual rate. So initially it was there, but now there is a proposal to remove it entirely and instead introduce a 25% pay as you earn rate for individuals. Those ones only who are earning in between a monthly pay and gross pay of 410,000 up to 485,000 Uganda shillings. Now, the third proposal is that 30% band that you may be aware of is that if that 30% band now only applies to individuals who are earning in between 485,000 to 10 million. Previously, that 30% band used to kick off at 410. So, and then the 40% band has been maintained for anyone earning above 10 million Uganda shillings. So basically across the board, we are seeing a saving in between 10,000 to 13,000 Uganda shillings, which on our end is a welcome amendment, though the cry from the public is that the government can do better. Yeah, they can expand the exemptions, etc. But let's wait to see what's going to transpire from the debates. Thank you. I hope that's clear.
Yes, very clear. Maybe we hear but also I think he was asking another question apart from was it from the telecommunication, if I'm not mistaken?
I didn't hear anything about telecoms, but maybe he can clarify or put in the chat.
Okay, now we go to Kenya.
Can I
Hello?
clarify? No,
Can we get a response from Kenya?
Yes, hello, Kenya here.
Yes.
On the first query, I note on why there's the proposal, or rather we've said that there's an anticipated amendment in cleaning up the zero rate and exempt schedule. That is a concern that has always been raised by the National Treasury, knowing that in Kenya, the zero rate schedule is contains even local supplies, which the National Treasury has always pushed that it contradicts the international best practice and has also been subject to abuse. So they've cleaned it in the past, but now they are projecting that they'll be eliminating all locally consumed goods and services from that schedule. That is the rationale behind we anticipating that proposition, because they've tabled it before. Okay. And even in the failed Finance Act 2024, there was a provision as such. And we also see it coming up, knowing that currently with the political regime and developments, there is high unlikely that they'll be incorporating additional taxes, and therefore they are more keen on ensuring enforcement and cleaning up of any tax leakage that they've been experiencing within the past few budget cycles. Yes. On the other query, if I got it right, was about review of the registration threshold. The compliance burden has increased, whereas the set threshold of 5 million has been there since 2013. So it is not keeping up with the pace of inflation and the likes, and therefore it is now more burdensome because the real economic value of that threshold as compared to the compliance burden is a bit higher. And even in the past failed Finance Act 2024, there was a proposal that it be pushed to 8 million.
Okay.
Yes, so those are the reasons behind anticipating changes within those particular two items.
Okay. How about the review of the VAT? What is the actually proposal from the maybe from the PwC or from the private sector? Because I can see review of the VAT rate on the fuel and petroleum.
Yes, review of the VAT rate on fuel products. We had earlier anticipated that it be reduced, and we've seen the government in the recent days having lowered it the other day from 16 to 13. Okay. And currently there is a legal notice lowering it further to 8 for the next 3 months.
Okay.
We know that it has been there before, and therefore we anticipate that come now the budget cycle, we anticipate to see that one now in an actual bill, because as it is, the law only allows the cabinet treasury to lower it by 25%, of which 8 of 16 is already in excess. Therefore, that one will be requiring a National Assembly approval and then the public participation process as well.
Okay.
Hence, it's incorporation.
Okay, thank you very much. I think I can see the hand. Please, can you speak? Hello.
Yeah, hello, hi. My name is George Warotera from
Yes.
Kenya here. I wanted to confirm about this, the reduction of VAT that has been announced. Can this be reversed, or is there a timeline for Parliament to pass this?
Okay, from Kenya, maybe quickly.
Yes, the law provides for a timeline within which the National Treasury Cabinet has to present it to the Parliament, for which a debate has to be held and then approval given. In absence of such applications or determinations within the set timelines, it might be challenged within courts, as we've always seen before with some proposals by the government being challenged. And this one being a proposal by the CS, even though it favors the common persons, there is a possibility that it can be challenged despite those benefits trickling to the common population.
Okay, now maybe we can have another two inquiries. We start with Martin, then Mr. Richard Koko, if you have any burning inquiry. Martin?
Martin Kabatsi, Tax Manager, Africa Improved Foods, Kigali, Rwanda. I just wanted the Rwandan presenter to throw more light on the VAT exemptions on capital goods and raw materials exempted from the VAT. Just clarity, briefly.
Okay, maybe before that, we can also hear from the Richard Koko.
Thank you very much. This is Richard Koko Mahudo from Busha Cross Border Traders Association, Sector Kenya Long Distance Trucker Drivers and Allied Workers Union. My concern was, is there a plan to expand the simplified trade regime, STR threshold, or product coverage in the new budget cycle? And two, my concern was, one of the private sector CSOs. What role will the private sector and CSOs play in tracking implementation after the budget has passed? Thank you.
Okay, thank you very much. I think we can get a response from Rwanda, and then maybe Jonathan will actually give you clarification on the expanding of the simplified threshold. Although you didn't say how much do you want actually the new threshold to be. From Rwanda?
Yes, thank you. So Mr. Martin, yeah, our law actually allows, so it used to allow for exemption, yeah, when you're importing capital items, yeah. So if you're importing some plants, perhaps for your industry and stuff like that, it used to exempt you from VAT. And pretty much it's just to sort of not tamper with your cash flow, because as you know, if you're importing and then you're paying VAT when you're importing and then later on you're going to claim it, it sort of tampers with the cash flow. It's pretty much a cash flow issue. But the one thing that used to happen is that the process to actually get that exemption is sort of lengthy. And I know most of the taxpayers, they were actually not going through that process to sort of get the exemption. But so what is going to happen recently is that I think the lawmakers, they've sort of realized that the provision of the law was, or rather the exemption was not meeting its target. So that is why they are going to remove it. So it's going to be you're paying VAT when you're importing, and then you go ahead and claim it. So it's you should be prepared in terms of cash flow wise, yeah, to sort of clear the importation, the VAT when you're importing, and especially when you're importing capital items. It's going to be quite a huge sum, but then you should be able to claim it or to get a refund, which is pretty much something that happens in Rwanda with the RRA.
Oh, okay, thank you very much. Jonathan, can you, I know maybe it's not part of your presentation, but this is an inquiry which we know EAC is handling. Someone was asking about expanding the threshold on the simplified trade regime for EAC.
Okay, thank you so much. I actually have got the question very well. Yes, we have had engagements with the cross-border traders, and currently the simplified trade regime threshold is 2,000, and we have had proposals. Some of them are proposing 5,000, and others around 4,000. But what we have done is we are going to present it to the sectoral committee on STIFI for guidance on how to proceed. So for now, I cannot say that it's part of the current proposals which are going to be considered in the next financial.
Sure.
Yeah, but the discussions are going on. Thank you.
Oh, okay. I think we are done. But also I think there is a very minor inquiries for Tanzania, I think, because some people are asking you, we didn't see a proposal on excise duty on goods. It was only on the services, especially communication, and we're asking if there is any proposal on excise duty on goods, especially we know products like alcohol, juice, beverage, they attract a lot of excise duty. If there is any proposal, if any, maybe we request also to be included in the presentation for any countries, for all the countries. And then when we wind up, when we are sharing the report, we share also the presentation to all the participants. So briefly from Tanzania, if there is any excise duty proposal for goods, especially those are prone to excise duty. Rafael, okay.
Yes, so we have taken note of the suggestions, and yes, we'll try to include the same in the slides as well. Because this time we've only covered the services, especially the telcos, which was actually pretty high. maybe in comparison with others. So we'll also take another look on the goods as well. Then we'll include it in the final slides before sharing. Yes.
Okay. On behalf of Executive Director, I would like to take this opportunity to thank all for participation, and more equally to the presenters from the EAC Secretariat, PwC, for actually collaborating with us in sharing the tax proposal measures across the EAC, the 4 partner states. I understand some participants were asking the tax proposal from the Republic of South Sudan and the Republic of Burundi. But you remember from the beginning, actually, we told you that those other countries have not aligned their fiscal year with other EAC partner states, especially Burundi is in the process of aligning their fiscal year to be in line with the other EAC partner state. But please note that this is a continual dialogue. We will continue engaging the partner state until we have the Finance Bill and the Finance Act. But also after the Finance Act, we are going to do the analysis to look which, for example, measures has been implemented and what is the implication to businesses across the EAC partner state. And we will come up with another webinar, which we call it post-budget webinar, which will highlight the new changes of the Finance Act from all the EAC partner states and how it has the implication to the trade and the business. So we take this opportunity once again to thank you for participating, and we encourage you to continue engaging EABC. If you have any inquiries, please write it to us, and then we will respond. From now here, I think we can declare our webinar is adjourned until we come up with a post-budget webinar. Thank you very much.
Thank you.
Thank you. Thank you. Thank you.
Thank you very much.
Okay.
Thank you very much.
Thank you.
Thank you. Thank you.